The biggest issue with pretty much all real estate, it's just a matter of debt. I mean, multifamily right now is seriously depressed, as you know. We're still buying things that are 30%, 40% discounted. The markets are extremely predictable on exit as well. We had a fund that was supposed to go for 5 years, but we exited at 2 years. We doubled everybody's money in 2 years. You're going to have essentially two classes. You're going to have people who have investments and people who don't. People who have assets are going to become increasingly wealthy. Those who don't are going to unfortunately miss out.
Welcome back to Lifetime Cash Flow through Real Estate Investing. I'm Rod Khalifa, and I'm thrilled you're here. And got a real treat for you guys today. Got Buck Joffrey on, who's been on my show, and he's got his own podcast that's a very good podcast called the Wealth Formula Podcast that I've been on as well. And we're going to have some fun today. Buck, welcome back, brother.
Yeah, thanks for having me, Rod.
Of course. So it's been long enough where probably ought to have you tell your background a little bit and, you know, why real estate, maybe where you started and kind of bring us current. So why don't we start there, buddy?
Yeah, so I am, sort of your classic A student. I was a guy who was sort of on that path, got good grades, went to fancy college, went to medical school, started out as a neurosurgeon, and then ended up, shifting in there, doing some more different kinds of things within medicine. But yeah, back in 2008, 2009, when I finished training, I actually kind of got inspired by reading one of these purple books from Robert Kiyosaki, as a lot of people do. And I discovered for the first time in my life that, hey, I'm actually, I'm an entrepreneur. I mean, I've been going through the motions of this world that's created for us through the educational system, but the entrepreneurial stuff really, really got me excited. And so I started actually just sort of doing more stuff within the business of medicine initially, and started making money. My family is a real estate family, so when I started making some money, I shifted into buying apartment buildings. And at that point was trying to figure out, hey, what am I supposed to do as a high paid, professional, in terms of personal finance. I mean, I'm not interested in doing the things that everybody else does. Find your wealth manager and, give them all your money and check in once a year. That's not what I was interested in. So I started listening to a bunch of podcasts, Rod, and just trying to learn the way a lot of people do. Found that there was a little bit here for me, a little bit there, but there was really no podcast focused on the high-paid professional looking at alternative assets, personal finance, macroeconomics, and ways that were different. And so I just started my own podcast, and that was Wealth Formula Podcast, and that was 2014. So it's been a while, and been doing this for since before it was popular. I think you have too. And so, yeah, that's pretty much the story.
Wow. So what are you just in multifamily now, or are you doing other asset classes as well?
No, I'm in other asset classes. Actually, some of the more interesting things we've done recently, for example, we have gotten into aircraft. And so it's in a very interesting space. It's actually very similar to real estate, because what we're doing there is, buying, potentially buying some like engines or aircraft. Like, for example, we had one for Air Portugal. We bought an aircraft there, leased it out. Those end up being very similar to real estate in that it's essentially a triple net lease, right? And the tax advantages are huge, because unlike in real estate, where you have to do a cost segregation analysis to get your depreciation, the entire thing is personal property. So if you have leverage, if you have 50% leverage, you actually get twice as much losses on your K1 than you actually invested. So very interesting. We just actually exited our first round, did really, really well on that. But yeah.
So did you partner with somebody that's got some experience? I assume that's the case.
Yeah. The way my model works is, listen, I have my own expertise, but I'm smart enough to know that I'm not smart at a lot of things. And so, in this particular case, my brother's very sophisticated guy, used to run the sovereign wealth fund in one of the Middle Eastern countries, and
Hmm.
huge contacts in all across the world. And we actually had an opportunity uh, to join up with one of his contacts who's been in aviation, for 40 years. And that particular contact is just a wealth of information, and has done extremely well.
Hmm.
We convinced them to do a retail fund because they're used to doing institutional funds, right? So, but again, my
Explain the difference. Explain the difference real quick, if you would, please.
yeah. So generally, those kinds of opportunities, they're not really available to people who can invest $50,000 or
Right.
$25,000. Those kinds of funds are, when you've got like, big offices, or, private equity that's going to put in 7-figure, 8-figure checks at a time.
Right.
So the goal for us was, okay, how can we take something that has been traditionally a, an asset class that is not something for us, right? It's out of our reach. How can we bring that to people who can invest in this 25, 50 grand, 100 grand at a time?
So
And so,
give
yeah,
me some more detail on the deal. Is yeah. So I just wanted my listeners to hear the difference between, industrial enterprise level investment, like it'd be a Wall Street bank or private equity, like you said, versus retail, which is what we do in our syndications. We raise money from private investors. But talk about that specific deal, if you wouldn't mind. I'm just for my own
yeah,
edification. I'm just curious. You bought a jet. How much? How much? Well, yeah, give me some numbers. I'm just
yeah.
curious.
So it's interesting. So we, the one for Air Portugal, that was, it was actually a used jet, and
Hmm.
it was a smaller jet, but it was a passenger jet, and it was about
Okay.
about 5 million bucks.
Okay.
And then the engines were about a couple $1 million a piece. And essentially, what you can do, because Rod, in these, if you imagine, how banks lend, right?
Right.
And you can get debt on this all day long,
Hmm.
because our engines were rented to Delta Airlines. I mean, and these leases that we have with the airlines are rock solid, right? They're not getting out of these things,
Hmm.
right? So banks are all over this. So we can get 75% leverage easily. Now, you don't always, in real estate, you don't always want that. Of course, you don't want that kind of higher
Right.
leverage. But in these kinds
Right.
of things, they're extremely predictable. And so the markets are extremely predictable on exit as well. I was actually amazed at how formulaic all of these things are. And when we exited, it was pretty much, we actually ended up doing really well, in part because, well, we had some good luck. There was some, in addition to the formulas that were used and stuff like that, there all of a sudden was a bunch of froth in the market.
Hmm.
And as soon as that froth came, we had a fund that was supposed to go for 5 years, but we exited at 2 years. And we ended
Hmm.
up getting the same returns. We doubled everybody's money in 2 years.
Nice.
And I'm not
Nice.
saying that, as I'm not saying that's what you're going to get every time, but
Well, no, of course not. Right.
at the end of the day, it's like, when you have these opportunities and you're with operators, like for example, right now, we're not doing a new fund because there's still froth in the market. We're going to wait.
Hmm.
We've got the right guys to know this market. I don't know this market, but there
Okay.
are nuances in this market that these guys know. They know when to go in, when to come out. My goal is really just to provide the
Capital.
bridge. Yeah, the
Yeah.
capital and the bridge between my investors and people in groups like that,
Hmm.
because I'm
What
not an
what
expert.
what other what other asset classes have you done? I mean, that's one we've never talked about planes on this show, but it's fascinating. What else have you done?
But mostly we've been sticking to real estate, right? But
Oh, you
within
have. Okay.
real estate, even within real estate, it's been self storage,
Okay.
those kind of self storage is great. It's another thing that's essentially a business, right? But it involves real estate. We've had some really good luck in that space. Mostly we've done multifamily. We're trying to shift again because of my brother's my partner right now, and he has a lot more experience on the private equity side. So we are starting to look at different things. I mean, like for example, this airline thing, was entirely
Hmm.
his creation and his contacts. We're just constantly looking to see if there's other things, hoping to look at potentially businesses.
Hmm.
Because I think that's something that, again, private equity, big money has a monopoly on these things. But, if you can get, say you roll up
Hmm.
uh, 5 or 10 businesses that are throwing off a couple $1 million each. Well, all of a sudden you've got these, valuations. You can put them together and sell for a higher valuation.
Hmm.
So
I've
there's
got a,
there's
I've got
all
a, I've got a, I've got a orthopedic surgeon in my Warrior program, my coaching program, that's doing exactly that. He's rolling up
yeah,
medical offices and rolling up paving companies right now.
yep,
Uh,
yep,
but yeah, it's because you can buy them at a certain multiple of EBITDA, and then you can sell them at a much higher multiple. And
exactly.
he's in the midst of doing that right now. One of my students, and so yeah, I love businesses too. There's 10,000 people a day turning 65 in this country. Okay, and a lot of them want to
Yep,
retire, and a lot of them own businesses. So,
yep.
we're also doing senior housing, which is very exciting in that same vein. But let me ask you a question about self storage. We before we started recording, we started talking about some of the pain in the marketplace right now, which I've experienced, you've experienced.
Yeah.
With pain, excuse me, with pain comes incredible opportunity as well. What have you seen in the self storage space? Have you seen the same pain? What's is it comparable? Is it different? If you could speak to
Uh,
what's happening in that environment.
Self-storage has been remarkably stable.
Yeah.
I think that if you think about it logically, like, the thing is that people have stuff they have to put somewhere, right? And it becomes almost like a noose around people's neck because they can't do anything. And
Right.
so, you want to be sensitive about uh rents, but
Rates. Hmm.
on the other hand, if you end up raising like $5, people are not gonna people aren't gonna
Right.
move. But you multiply that times couple hundred units every 6 months, it ends up becoming a bigger thing. Rod, I think at the end of the day, I think the biggest issue with pretty much all real estate, one of the things that it's just a matter of debt, right? I mean, I think
Hmm.
debt becomes the concerning thing. Fortunately, in self storage, we've been able to do just fine. But if the rates hadn't gone up the way they did, we would have done extraordinarily well.
Right.
And so
Right.
I think as an asset class, I think it's still fantastic. Um, I don't think it's depressed like multifamily. I mean, multifamily right now is seriously depressed, as you know. I mean, we're
Right.
we're we're still buying things that are 30%, 40% discounted. If you
Right.
just look at cost basis compared to 2 or 3 years ago, you
I'll
know.
give you an example. We have a 200 unit asset in San Antonio. Right next door is a 300 plus unit asset. It sold for 43 million in 22. It's with the bank. It's down to 28 now, and I'm not even interested unless it hits 24. Same vintage as the one we have, which is 95% occupied. So love to have it. I'd love to have 500 plus units right next to each other, but that's what's out there right now, and so. Very, very interesting times. There's a lot of pain in the market, but there's also a lot of
Yeah,
opportunity. Also, a lot of opportunity. And I don't know if you've noticed, expense ratios have gone way up.
yeah,
I teach a 50% expense ratio, and that's too low at this point. 60% is really more like it. So have
yeah.
you noticed the same thing?
Yeah, yeah, absolutely. I mean, I think,
Yeah.
I think, but I think one of the key things for people to think about, and I have been talking about this a lot, is that, as you said, with the pain comes opportunity,
Hmm.
right? The one thing I really hate for people to do is to miss out on this period of opportunity, because as you've seen throughout the years, the distance between pain and froth can be 2 or 3 years,
Yeah.
right? And so to me, it's like these are times when you have to really get the intestinal fortitude to say,
What's Warren Buffett's quote? Be scared when other people are excited, and be excited when
right,
other people are scared. It's
yep,
exactly it's contrarian investing, exactly what we're talking about, right?
right. And if you look
Yeah,
at the macro picture, we know that, rates have already ticked down. I believe they're going to continue to tick down because, I
right.
mean, look, we've got a Fed that is the worst, just got picked for the Federal Reserve chairman. I mean,
Mm-hmm.
he's been talking about. I think his quote was, "We can go a lot, we can cut a lot from here," and I
Mm.
think one of his reasons for that is because of the deflationary pressures of artificial intelligence that he's foreseeing, which I think the smart people are seeing that. I'm not sure all bankers are seeing that, but
Let me
he
speak to
sees
that
it.
for a second. Let me speak to that for a second. I was listening to Elon Musk on Joe Rogan. His latest
Yeah,
interview. He's been on there more than once, and he basically said that any job in front of a computer, I mean, they're going to go like wildfire. They're going to be gone. And even in the medical space, candidly, I know you're an MD.
yeah,
I mean, in the medical space, the surgeries could be done robotically here better than a human can do in very short order. And so, I've been kind of shouting it from the rooftops. If you're in a field that that could be impacted by AI, you should consider starting to think about a side hustle, be it buying businesses, buy it real estate, whatever it is. But get started now, so that when the shoe drops, you're already well into something. That you can reinvent yourself if you have to. And I think we're going to see a lot of pain with this. With this AI phenomenon. I mean, it's extraordinary what it's able to do at this point, but it's going to eliminate jobs. And so, if you're thinking that's a possibility and you're listening, you should be, considering side hustles to start. Do you agree with me here on this, Buck?
100%. And the
Yeah.
other thing that I think is going to happen as part of this pain is you're going to see an increase in this disparity between the haves and have-nots, because
Mm-hmm.
what's going to what's what's going to happen is you're going to have essentially two classes. You're going to have people who have investments and people who don't.
Mm-hmm.
And things are going to become more valuable. Companies are going to become more valuable. Why? Because AI is going to cut their expenses. They're going to be
Mm-hmm.
incredibly productive. People who have assets are going to become increasingly wealthy. Those who don't are going to unfortunately miss out. And that disparity is already there, but it's going to get worse.
In that vein, let's talk about the U.S. currency. I interviewed an economist here in my studio, and this was over a year ago, and he told me that really 80% of the U.S. money supply was created during the Biden administration. That we printed 80%. Up to that point, it was only 20%, and so inflation's not going away.
No.
And our debt, national debt, keeps going through the roof. And I know, the Supreme Court has got a rule on Trump's tariff thing, where the appellate court struck down his ability to do tariffs, and it's at the Supreme Court. And how do you feel about the country economically as it relates to I believe that Trump wants to use those tariffs to mitigate that national debt if at all possible, but and bring manufacturing back into the country and all that. Do you have any thoughts around that at all?
Well, I think a lot of people, including me, thought that tariffs would spike inflation. We didn't really see that,
No.
and so Scott Bessent was pretty confident that it would not as well. He thought maybe there would be some transient rises, but listen, I think overall, this idea of raising revenue through tariffs, so far it seems to be working quite well. you
Right.
know
And
so
he's able to use it for leverage as well, because they've been screwing us for years. I mean, he's able to use it as leverage to bring some of these countries to bear. So
yeah,
yeah.
and even onshoring manufacturing, if you think about like the potential, what that means for the US. I mean, it means bringing back jobs, yes, but also again, going back to our entire conversation about artificial intelligence and robots and things like that, uh,
Hmm.
it actually gives us an opportunity to bring those manufacturing businesses back and to make them more efficient using technology that's coming through the pipeline. So
Yeah.
traditionally we have always outsourced these things because it'd be less expensive to have other countries do them. But if you can automate and have robots involved, I mean, it's almost sounds science fiction, but I mean, listen, Elon Musk is closed down a good chunk of the car factories to focus on the Optimus
Right.
robots. This is coming. This is
Oh, and they and
real.
they've laid off a ton of people. I mean,
Yeah,
Meta has laid off a bunch of people. Amazon has laid off a bunch. I mean, tens of thousands, and they're at the forefront of this thing. So it's going to hit all businesses here eventually, and that's why I want to throw that word of caution out there, not to scare you if you're in one of these jobs, just to I've had to reinvent myself 3 or 4 times in my lifetime, and it's scary. Change is always scary, but by God, being forewarned is forearmed, and being proactive rather than reactive is super important. And
yeah.
so,
I was talking to a younger guy yesterday. It was a software engineer,
mhm.
and it's interesting because he's right in the crosshairs of this thing,
Oh
right? I
yeah,
mean,
oh yeah,
and I was talking to him, and I was like, and he was kind of in denial about this, and I was kind of
really,
shocked. Yeah.
wow.
And he at some point even called it maybe a little bit of a fad, and I was like, I really don't want to scare you, but I think you've got to start thinking about this as your, what is it, the Kodak moment, where,
Oh yeah,
the Kodak
Blockbuster,
company.
Kodak, whatever.
Yeah.
Yeah,
Yeah.
exactly.
If you don't know, if you know that something's coming down the pipeline, stop the denial, because otherwise you're going to be Blockbuster.
You're
You're
going to
going
have
to,
some pain. You're going to have some
yeah,
pain. That's it.
yeah,
You can avoid that pain if you reinvent right now and get
right.
started. Figure out what you would love to do. Start it on a side hustle. There's nothing you can't do on the side. Don't tell me you can't, because you have the time, even with kids and a family. So start your side hustle, and because it's going to take time to learn anything. So you have to get started.
Yeah,
But yeah, no,
absolutely.
we're in agreement on that. So what's next for you, brother? What are you gonna be doing next?
Well,
What's under your radar? What are you looking at?
well, I mean, I think it's just a matter of continuing to look at what the market gives us, right?
Yeah,
I want to be flexible. Traditionally, our investor group has been real estate heavy, but again, there's lots of opportunities. I mean, this aircraft thing completely opened my eyes. I'm like,
yeah.
we're just barely scratching the surface on the things that can possibly be available, to retail investors. So
And yeah, the roll up idea is a phenomenal idea. Like I said, my student Tyson's killing it with that right now, and there's lots of opportunities to do that. Service related business, HVAC, plumbers, electricians,
yeah,
so on and so forth. There's just a lot of opportunities, verticals that you could do a roll up in.
yep.
And make some nice money. And so what else are you up to? I think you mentioned before we started recording something about life insurance.
Yeah, it's interesting because you know, Rod, I have not traditionally been a guy who's been invested in the stock market very much. I
Yeah, me
kind
either.
of generally avoided that, and part of it is because I felt like there's less control. Yeah, it's just not been part of my DNA. But it's hard to deny when you look back 50 years, that people who have consistently been in there have done well. And so one of the things that I got really interested in, and it's funny, Rod, I think you used to be involved with Tony Robbins. How is
Oh
that
yeah,
right?
big time. 20
Yeah,
23 years with
yeah.
Tony. Yeah.
Do you remember the book he wrote on money, Master the Game? Do you
Yeah,
remember
great
that
book.
book?
Great book.
And
Yeah, great book.
there was a section in there, when I read this a few years back. I really wanted to follow up on it, and Tony was talking about a product that a lot of high net worth people use, where you can essentially take the upside of the stock market, basically meaning when the market goes up, you can take the gain, but when the market goes 20 below, it
Hmm.
loses 20, loses 50, like it has multiple times in the
Right.
last few several decades, you don't participate. And so I was fascinated by this idea and got interested, got an insurance producer's license in part to try to figure out how you do this. As it turns out, yeah, that product does exist. And it's basically done by these insurance companies. The major insurance companies have been around for 100 years plus. And it involves an options play, essentially. And
Right.
so what they allow you to do is say, okay, you're going to take, you will every year, you have this amount in your account. If the market goes up by, we'll let you have the first 10% of the market. And if you make that 10% up to that 10%, that's yours. If it goes more than that, you don't get more than that. But in return, what we're going to do is if the market goes to, let's say, 0 or even 1%, you can't go below that. So
Hmm.
every year, essentially, you can either gain or not gain, but you can't lose, right? I thought that was fascinating. Now, what's interesting is that in the ultra high net worth world, you add one more layer to that, and that layer is leverage.
Hmm.
So now you can imagine that people say, well, gosh, market went up 20% 2 years ago. Now I only got 10%. Well, at least you didn't lose, right? But now
Right.
if you've add leverage to those years that you're gaining, you're actually getting the same type of potential upside, not just 10%. You're reaching into the 17s, 18s, 20% if you reach your cap. Why? Because you're using leverage,
Right.
right?
Hmm.
So this type of thing was not really available to, again, my cohort, which is, people who make a couple $100,000 a year, you know,
Hmm.
because again, premium financing those premiums would be like, okay, we're going to do $1 million a year. Well, we don't want to do that. So there's this strategy that we've essentially my partners have created, which essentially allows people to do this, at $25,000 a year for 2 years or $50,000 a year for 2 years. So what we do is essentially you create a base, right? You create a base with that first 2 years. Say you put in $25,000 for 2 years, and now you have a base of 50,000.
Okay.
Now you add leverage to that every year after that. And the leverage actually comes from inside the policy. So you're not actually borrowing money from a bank, you're not putting any more money in. You're actually funding your own policy from loans within the policy.
Okay.
Now, so what that does is it creates this pretty impressive type of feed forward thing where if you go back and you model this out 50 years, if you model it out through the Great Depression, it outperforms virtually every other situation in which you just put money into the market every year.
Hmm.
It's pretty incredible, but I
So let
have
me ask
to,
you a question. Let me
yeah,
ask you a question. So how do they mitigate the? I guess they must have like put options or something where they mitigate the potential loss, but they make it up through their actuaries where they if they
yep,
make the gain, it offsets any cost of the put ups. Okay, I think I could see how
yeah,
they could do
yeah.
that.
And we're
Interesting.
talking
So
about
you
like
so
Penn Mutual, Nationwide. These are like this isn't like I
big
use,
companies.
yeah,
Right.
yeah,
Okay.
yeah,
Interesting. Well, wow. Okay. Well, that's way above my pay grade, but sounds fascinating. I do enjoy talking about it. But are you still actively looking for some multifamily? Are you still looking
oh yeah,
for deals? You
yeah,
are. Okay.
yeah.
Okay.
In fact, right now, we're even like we have something going on in Raleigh right now.
Okay.
40% discount on cost basis is 2 or 3 years
Right.
ago. Yeah, you were finding them because off market stuff. It's all off market
Right.
right now, and it's not because these assets are performing badly, but you're seeing. I think probably this year is going to sort of flush out the rest of the the bridge debt,
My,
you know?
my SEC attorney said he had 6 foreclosures in one day, apartment complexes.
Yeah,
This has been 3 or 4 weeks ago, and I'm sure he's got more since then. But yeah, no, I mean, there's some pain. There's some pain. I've experienced some pain. You probably experienced some pain, but
yep,
we get through it. We get up and keep our head up and fight through it. But again, with crisis comes opportunity, as you just mentioned. You got one at 40%
right,
off. That's a hell of a deal. As long as the
yep,
numbers pencil. It's all about the
yep,
cash flow. Well,
100%.
listen, Buck. I appreciate you coming on, and guys, the name of his podcast is the Wealth Formula Podcast. I'm going to be on it again here in short order as well, and so check it out. And it's good to see you again, my friend.
Yeah, thanks for having me, Rod.
Absolutely.